Sherwin-Williams has made the surprising decision to put a hold on its 401k matching contributions due to weaker-than-expected sales, a move that strikes at the heart of employee benefits and raises many questions about the company's future. But here's where it gets controversial. This suspension directly impacts employees' retirement savings and sparks debate on whether such cost-cutting measures are truly necessary or if they risk damaging morale. The announcement came from Sherwin-Williams CEO Heidi G. Petz, who explained in an internal memo obtained by Cleveland.com that a mix of unfavorable economic conditions has forced this tough call. High mortgage interest rates have drastically reduced home buying to near historic lows, which in turn has brought down demand from both homeowners and professionals in sectors like remodeling and construction. On top of that, inflation has dampened the do-it-yourself market for 3 years running, further pressuring sales. Petz also pointed to the impact of tariff policies, which have raised the costs of raw materials and components crucial to Sherwin-Williams paint and coatings products. Such tariffs have not only squeezed profit margins but also dampened industrial demand, making the financial environment even more challenging. Sherwin-Williams is not immune to these prolonged and intense external pressures, Petz admitted. Customer demand is softening, and in some regions, conditions are deteriorating. This suspension, set to begin on October 1st, will halt the company's current practice of matching 100% of the first 6% of employee contributions to their 401k retirement savings. While this is a significant cutback, it's not unprecedented. Sherwin-Williams enacted similar freezes during the 2009 financial crisis and again amid the COVID-19 pandemic in 2020. In both instances, the company eventually reinstated the full matching benefits as economic conditions improved. However, Petz did not provide a clear timeline for when employees might expect the match to resume this time around, leaving many uncertain. To navigate these tough times, Sherwin-Williams has already taken steps described by Petz as disciplined, responsible, and aggressive. The company has cut third-party expenses, streamlined operations, delayed hiring, and restructured assets globally to enhance efficiency. Earlier this year, the company also offered voluntary buyouts to select staff to reduce payroll and simplify management layers, offering financial incentives to those who opted to leave by the end of June. These moves come amid broader signs that the U.S. labor market is cooling, a factor often overlooked when assessing Sherwin-Williams' challenges. Nationally, job openings dropped sharply from 12.1 million in 2022 to 7.2 million in July 2025. Hiring has slowed dramatically, at less than half the monthly growth rates seen last year. Layoffs have inched up slightly as well, though the number of workers voluntarily quitting has remained stable, indicating cautious employee confidence. Sherwin-Williams is also dealing with specific operational setbacks, such as delays in opening their new Cleveland headquarters. The 36-floor building was slated to open in 2023, but has encountered fireproofing problems related to one of the company's own coating products. Meanwhile, the company recently mandated a full return to office for all U.S. and Canadian employees by January 1st, abandoning remote or hybrid arrangements previously allowed during the pandemic. Despite these hurdles, Petz affirmed Sherwin-Williams' commitment to investing in its future growth, including plans to expand its retail presence and bolster its field sales team. The company's stock price reflects a mixed picture, trading at about $365 late last week, which is down slightly from its August peak, but still up about 18% compared to spring lows. It remains well below the 52-week high hit in November, underscoring ongoing market uncertainty. Adding fuel to the fire, the American Coatings Association had sounded the alarm months ago about how tariffs, introduced during the Trump administration, and retaliatory tariffs by countries like Mexico, Canada, and China would hurt paint manufacturers in the U.S. Many vital raw materials come from China, and alternative suppliers are scarce, making the tariff impact particularly painful. Looking ahead, Sherwin-Williams expects these economic challenges to continue through at least mid-2026. Yet Petz insists that the current suspension of the 401k match is a temporary, strategic move intended to help the company weather the storm while still supporting its workforce and maintaining investments for future success. This decision opens the door to a whirlwind of questions. Should companies halt retirement contributions in tough times, or is that a step too far in cutting employee benefits? How much should external economic factors influence corporate policies that directly affect employees' financial security? And finally, in an era of tightening labor markets and shifting work environments, what strategies best balance cost saving with employee loyalty and morale? We invite you to share your thoughts below. Do you agree with Sherwin-Williams' approach, or do you believe there are better ways to manage through economic downturns? What would you want to see from companies in similar positions? Let's discuss.